what do we do with our money? Like, what should we expect to cap in? How do we control this? Like, what do we do to protect ourselves? And there's a lot of very smart people in the room, 200 people that all have the mindset of entrepreneurs, of business owners, of investors, and understanding that following the status quo and following, what the masses do doesn't always end the way that you want it to end. Welcome to Money Club Mondays. I don't even know what the date is, May 9th already, 2022. So just getting back from a weekend in Daytona Beach where we hosted the annual Money Multiplier Millionaire Mindset Mastermind event. So it was kicked off with a party at Brent Kessler's house on Thursday evening, kind of a big networking event. Everybody was having some drinks and having some food and having a good time. Actually, a few people got to take off and fly in one of his little private airplanes, which was pretty cool. We went up, took off, and flew over the beach, circled back around, and landed right on the private runway, and then taxied right up literally to his backyard, which is a big hangar. So that was a pretty awesome time. And then all day Friday, all day Saturday was in the big ballroom. We had about 200 people there, and multiple speakers talking about infinite banking. And it seemed like the general theme for the entire weekend was, what do we do with our money right now? There's a lot going on in the markets. There's a lot going on in the world when it comes everything from just getting past COVID right now and all the global supply chain issues that's created, and the lockdowns and the shutdowns and the closing down of the economy. And it's never been done before in history. So to kind of help with that, the Fed and the Treasury and the government came out with a bunch of policies and printed a bunch of money and worked in conjunction with each other to keep things going, and printed something like $8 to $10 trillion over the last 2 years, somewhere between like 65 and 80% of the entire money supply ever created in history. 60 to 80% of it has been printed in the last 2 years. So when things like that happen, the last 12 years or so since 2000, since the collapse in 2000, 2008 and the recovery, and starting in like 2009, going into 2010 and beyond, we've seen a real strong market. So we've seen ups without a lot of dips. We slightly saw something in 2020 when COVID happened, but boom, again, like I just said, everything kicked in and we start shoot back up. So the last 12 to 14 years has been just a solid bull market and very, very strong. And, before that, it was very strong since the year 2000. So we've been in this perpetual bull market for a long time. And we're starting to see some volatility come into play with things in the stock market. So I don't know, and then in the middle of that, crypto has been introduced, and crypto's just ran wild, and everything just seems to always go up and up and up and up. The real estate market has just gone bananas. I mean, in a lot of places, real estate prices have doubled in the last year or two. So we've seen a lot of just crazy growth and appreciation. And it seems like whenever this kind of thing happens, though, it can't last forever. And it seems like we're starting to see that right now, where investor confidence and investor sentiment is starting to back off a little bit, and people are starting to wonder and worry. And we're going to start seeing more and more of this, I think, with fear, especially as these markets start to go. And I was just looking at a chart earlier. Let me see if I can pull this up real fast. So I was looking at this chart earlier just of the Dow Jones. I mean, if we look today, we're down. If we look over the last 5 days, this was that rally we had last Wednesday after they introduced, and the Fed said they were doing a 0.5 point increase, which everybody expected, and it was kind of baked into the markets and the news. So there was a little upswing right here, but it didn't last long. The next morning, we had a hard drop, and it wiped out all of these gains that we saw from that expected Fed response. And ever since then, we've just been coming down and down and down, and closed last week, the 6th week in a row that the Dow is down. The NASDAQ, I can pull up the NASDAQ as well, but it's been getting hammered pretty good. So if we look at the last month, we see a little trend going down. The last 6 months, a whole lot of volatility, a lot of ups, a lot of downs, but trending down. So a lot of the conversation, even year to date, and then we look at even the last year. So the beginning of January, we saw some increases, but it's just been coming down since. So there was a lot of talk at the training this weekend of, what do we do with our money? Like, what should we expect to cap in? how do we control this? Like, what do we do to protect ourselves? And there's a lot of very smart people in the room, 200 people that all have the mindset of entrepreneurs, of business owners, of investors, and understanding that following the status quo and following, what the masses do doesn't always end the way that you want it to end. And that's proven. You guys hear us talk about like the Social Security Administration, how they say 95 out of 100 people are not going to retire in the lifestyle and the age that they want to and the way that they want to. So how do we avoid things like that? How do we avoid that volatility that we see in the markets? The three wealth killers that you hear us talk about when we talk about the foundation of money school: taxes, inflation, and volatility. Those three things will kill your wealth and kill your investments. So how do we start planning for that? And what do we do with that? And one of the things that we talked about this weekend was, getting out of equities and having our money in other places. So this was something that Chris and the team that we created last year, and it's been changed a couple times here and there. It's modeled off of Ray Dalio's all weather portfolio. So we just named ours the all seasons portfolio. So we talked a little bit about this past weekend. And so you'll see the large portion over here in the light purple long-term treasuries. So that's something that you see, Chris really is pretty heavy in. And we've done trainings on this before, so I'm not going to talk about it too much right now, but basically long-term treasuries, the reason why we feel like it's a good place to have a portion of wealth of our portfolios right now is because of the inverse relationship of how treasuries, of how bonds work. And what that means is we have this inverse relationship right here. So if this line right here is interest rates, what do we know that the Fed is doing right now with interest rates? The Fed has told us that they're increasing interest rates right now, okay? So as the Fed increases interest rates, what happens is there's an inverse relationship. So bond yields decrease. Okay, so our bond prices, I should say bond prices, not interest rates, bond prices decrease. Okay, so the Fed has already, they just raised the rates, I think on the second or third time this year. They just increased the last week by 0.5 point. They've told us they're going to increase another, I believe 4 times this year for a total of 7 increases. Now, if we see the volatility really start to kick in and the market start to drop, I think and inflation continue to run wild, I think they're going to even have to come up with stronger than 0.5 point increases. But nonetheless, the Fed has told us they're going to increase rates. So when rates increase, bond prices decrease. So the reason why we're saying get into treasuries is we want a dollar cost average in as these things drop. So as the bond prices drop, we want a dollar cost average into these things, because again, you're never going to time a market. You're never going to be able to time exactly what the bottom is. So we want to buy in as they're on their way down. Now, what do bonds pay? 3%, let's say, right? So nobody gets excited about 3% returns buying into these things on their way down. However, the reason why we're doing this is because interest rates are rising right now. But if we see a market collapse, if we see things really get ugly in this country, and we enter into this recessionary time, well, the Fed's going to have to step in and do something to fix that problem. And one of the things they do to fix that problem is they lower interest rates. Okay. So they're having an increase, and they're probably going to increase them quickly right now. Let's just take the hit, and then they can reverse and start decreasing these things. Well, as interest rates come back down, bond prices are going to come back up. Okay. Because people are going to want to get into these types of investments. And what happens is every approximate 2% is going to increase 30 to 40% those bonds, the price of the bonds. Okay. So if the interest rates start really dropping again, let's say they drop them back down to 0, 1%, something like that, we're going to see these 20, 30, 40, 50, 60% increases in the bond prices. So as we're buying the way down, at some point we're going to bottom out. This whole chart is going to reverse, and then we're taking advantage of these gains right here. So again, we're not worried about this 3%. We don't care about that at all. What we're looking at is this over here. And Chris has done several trainings on this on the YouTube channel. We talk about it on the wealth webinar. So make sure you guys are following along with that. Also, one thing I'll mention on the YouTube channel, I opened this up with Let me pull it over here. Hopefully you guys can see this. So I opened this up with a couple of shorts that we were doing. So starting in a couple weeks, the Chris Naugle YouTube channel is only going to have our edited content on it. So all of our videos that we do and we put out different trainings, things like that, that's what's going to be on the Chris Naugle YouTube channel. Money School TV is going to have all of our streams, all of our webinars, all of these Money Club, or some of these Money Club Mondays. Most of them are going to be private behind Money Club, private Money Club, but some of them will be put on here, some of the trainings and stuff like that. So if you guys are not already, make sure you go to this. Just go to YouTube, type in Money School TV. We cannot get a youtube.com/Money School TV domain until we get like 500 subscribers. So if you guys could go to Money School TV, just type it in the search box, click this right here. This is what the logo looks like, and go over here and hit subscribe. And then if you go this and hit all, if you ring that bell, that'll really help us, and it'll get us be able to get us the domain name that we need to be able to start using this. But anyways, in a couple weeks, all of the streams. So the WTF podcast that we do every Wednesday morning, the wealth webinar streaming, the Ask Me Anything streaming, the business building on Thursdays, it's all going to be streamed, and the recordings will be put on this Money School TV YouTube channel. So I just wanted to make sure you guys are aware of that, and please go subscribe and ring the bell on there real fast for me, just so we can make sure that we get that going. Oh, I'm showing the pie chart still. Sorry. Let me pull it back up. Okay, so here's the Money School TV. Sorry about that. Okay, so I was just saying, the Chris Naugle YouTube channel right here has everything, and then Money School TV. So if you just type in Money School TV in the search bar, hit enter, it'll pull up some different things. But this one right here, click that, hit subscribe, hit the bell right there, and that's all you got to do. And that way you'll be alerted anytime we go live, whenever we start sharing things and stuff like that. Okay. Hopefully you guys saw this before when I was talking about the Dow chart too. So, all right, so here we go. So let's get into this a little bit. So that's what we're talking about when we go back over to this all seasons portfolio. So that's the reason why you see these long-term treasuries, because of that inverse relationship. We want to be able to take advantage of that growth. And again, what are US treasuries? Depending on what you think about the United States of America, US treasuries, you're basically betting on the United States. So if you believe the United States is the best country in the world, that we're going to be around for a very long time, then US treasuries you can look at as basically a risk-free investment, because they're backed by the full faith of the US government. So, being able to get 30-40% returns on something that's basically risk-free becomes very, very nice. And then last Wednesday, go on the YouTube channel and check it out if you missed last wealth webinar, but we talked about I bonds and how you can buy those and get 9.62% right now returns. Even if you sell them after a year, you're still at like 7.5% after taking the penalty for selling after a year. So a 7.5% yield return on a risk-free investment is not bad in this market that we're living in right now. Again, remember, inflation's running at 8.5%. So three of those wealth killers, inflation and volatility, are kicking in right now very, very, very hardcore. So it creates this strange environment that we really need to understand where our money is and what our money is doing for us. Because again, it's not like the last 10 or 12 years where you could throw your money anywhere. You could literally throw it into any real estate mutual fund or index. You could throw it into any crypto project, crypto coin. You could throw it into basically any housing across the country, and you made money. That was the last decade. This is much different now. So we need to start, if we're not already, smart with where our money is and what we're doing with it. So that's why we're going to talk more and more about this kind of stuff. So the treasuries over there, equities, you can see, are a very small piece. So for that 5% in equities, I would say 0 to 5%, depending on if you want to actively trade a little bit. So that 5% for me are plays that I think are going to be good in the long term. Like, I still think Tesla is going to be a good play because of the direction that we're going. And I really like what Elon Musk is doing. I think Twitter is going to be a good play because I think after all the noise and after all the pushback, when Twitter does take it over, now it's going to be he's taking it over as a private company, but it's something to watch how some of these other social media companies react to it, and what's going to happen with that. So things like that, just watch out for, if you're in the equities market, watch out for plays that you like, things that you think, like Chris always talks about, things that you understand, things that you like, things that you know about. And then for me, equities are, a little bit of buying and selling too. So as I see plays that are going up or down, I'll do those. So a little bit more active in equities, but I'm just not a huge fan of stocks in the first place. So gold and silver over here, precious metals, 10% of your portfolio. That's more of just a legacy play. I mean, precious metals are always kind of the go-to in times like this when we have inflation and volatility and things like that. So of course, you guys have heard us talk a lot about precious metals recently. We have a really good relationship with a company, 7K Metals, and we're talking all about that every Thursday at 3 p.m. Eastern on the building business and precious metals webinar that we're doing. So join us on Thursdays if you want to get more into gold and silver and all the pros and cons of those. Very easy way to buy at the best prices from a great company though, in 7K Metals. So just let me know if you want to learn more about that. Alternative investments are going to be things like real estate, private money lending, even crypto, notes, things of that nature. And then down here, you see the 30% in cash, infinite banking, private banking. So obviously IBC, infinite banking and private banking is what this entire last weekend was all about. Because the way we look at it is our money in these policies, in these private banking policies, is just as good as cash. It's liquid. It's available to us when we need it. It's just instead of sitting in a savings account in true cash at a bank in a savings account where you're growing your money at 0.1%, or even in a under your mattress, as people say, where it's doing nothing. At least we're taking advantage of uninterrupted compounding growth within these policies. Now, again, the money in these policies sitting there, we don't necessarily mean it needs to just sit in the policy and not keep moving. Now, if you were at the weekend, the training this weekend, there was a guy named Jason Lowe who did a really cool presentation, and he's got more and more of his cash and policies. He's got millions of dollars in policies, but more and more of that money is literally just sitting in those policies waiting, because his plan strategy is to be ready to go when things drop and start buying things on sale. So that's something to start thinking more and more about as we start seeing more and more volatility and come down of the markets and corrections and everything that are coming up. So outside of that, what can we do to keep this money in our policies moving, but keep it in a somewhat short-term investment where we have access to it, where it's guarded against? And that's where some of these private money deals can start to come into play, because we can do some of these shorter term 3, 4, 5, 6 month investments into these deals where they're getting these, if the deal's right, they're getting the real estate flip done. It's usually going to be a flip. So they're able to get it done quick enough where they're going to buy it, get the work done, and get it sold before the real estate market starts to change, and before things really start to hit. So there's some possibilities in there. Outside of that, if we're doing longer term stuff in there, we just need to make sure it's in the right asset classes, so things that do well in downturns and whatnot. So this is the all seasons portfolio, and we'll talk more and more about this. We'll make slight adjustments to it as things go. But any questions on that before I move forward? Any questions on anything inside of there or what that looks like? And again, yours might be a little bit different. This is just kind of what we're trying to look at, what we're doing with our portfolios right now. All right. So with that being said, the other kind of theme of this weekend, as I was saying before, was, well, what do we start doing with our money? I mean, looking at that all seasons portfolio, we have a job, we aren't experienced with investing, and all this stuff. So let me pull up something real fast here if I can find it. 1 second. I'm going to pull up 2 things for you guys real quick here. All right, so I'm going to go through this real fast. You guys have probably seen this before. Actually, before I go through this, let's do one more thing. All right. And just so you guys know, realize I actually had a borrower that was supposed to come on today. and something came up and they had to go out of town. And I just being gone myself over the weekend, I didn't have a chance to get another investor to come on today to share a deal with you guys. But moving forward, this Money Club Mondays is going to focus on borrowers and deals and investments. So I'm not going to do as much training on here moving forward. It's going to be more picking apart the deals that are in the private money club, because one of the biggest things I had was people this weekend coming up and talking to me, hey, I'm in the private money club, or I'm going to join the private money club, but I still don't know who to lend my money to. Like, I don't know who these people are. I don't really know completely how to underwrite the deals or what the questions are I need to ask and things like that. So moving forward, I'm going to try and be the interviewer for these people on behalf of you all that are lending money. So if you're a private money lender, make sure, and you have money ready to go, or you have money coming up in the next month or so ready to go, make sure you're on these Money Club Mondays, or you're watching the recording right afterwards, because this is how you're going to find your next deal. And if you're a borrower, if you're an investor and you're looking to raise money, if you have a deal available now or one coming up within the next couple of weeks, then please reach out to me and let me get you scheduled for the show, because I want to bring you on here and let's talk about it. You can bring it up, the deal, talk about you, your experience, and be ready though. Have your numbers ready, because I'm going to hit you hard. I've been watching Shark Tank again. It's one of my favorite shows. I got away from watching it for a while, but I'm watching it again. So I'm going to hit you with those sharky kind of questions and get you to dig into your numbers, dig into your business, dig into your deal, and make sure it's a good deal. Because I'll tell you one thing, if I don't feel comfortable investing in a deal with my money, then I wouldn't want any other lender on here to do it themselves. Now, your risk might be different and you might take that risk, but I'm going to hit the questions that you need to know to make that determination on whether it's a good deal. And then if it is, then you connect with that investor and you guys hash it out and go from there with it. But so that's what this Money Club Mondays is going to be primarily moving forward. Again, today, I just had somebody back out over the weekend. I didn't have time to replace them. So I just wanted to go through some stuff that I had heard over the weekend that I think will set up really nicely moving forward as we get this going. So Greg was saying, I was planning on joining PMC in less than a week, so looking forward to being on the show. Yeah, absolutely. And yeah, just shoot me an email. I'll put my email in here in case you guys don't have it. Any email you have for me works, but here's one too. snaggy@chrisnaugle.com. Shoot me an email if you are a borrower, have a deal, and you want to hop on the show. I'll bring you on. And that is no charge right now. We're not charging anything for that. I always tell people that you vet the borrowers to ensure no shady people. We do, Catherine. Yeah, I do try and vet and talk to all the borrowers and things like that. Make sure they have some experience, or if they're new, then you know that they're new. There's nothing wrong with a new borrower, a new investor. It's more what's their background, why are they doing this? What's their experience? Do they know what they're doing? But if they're new, that's not necessarily a bad thing. If they haven't ever done any deals before, but the risk might be a little bit higher. So maybe they need to be willing to pay a little bit more interest or pay some points on the deal or something like that. So even if you're brand new to all this, there's nothing wrong with that whatsoever. So this was the thing. Again, this weekend, a lot of people kind of talking about that, like, how do we find these lenders? What does that look like? So that's why I want to start for these borrowers. So that's why I'm going to start bringing them on the show. So right now, though, let's start thinking about our money again and where it's at. So, where is my money? So now what? So basically, when you're looking at your money, you're going to have basically 3 different buckets, right? Maybe 4 different buckets. Let me say that. All right. So what are these 4 buckets? Like, where are you guys' money right now? And I can show you how these buckets work together, and then which ones make sense to do private lending with, which ones make sense to do precious metals with, which ones make sense to do equities with, things like that, right? But we got to know where our money is first and what our options are with that money, so we know how to move it to beat volatility, inflation, and taxes, the 3 wealth killers. So one is going to be cash. While I'm at it, let me make a note to myself. You guys, where's your money? Put it in the comment box. I'm making a note to myself to buy new dry erase. Do you guys write things down too? Okay, I got to write things down or I'll forget them. All right, so buy new dry erase markers. I made myself a note. All right, so policy. Okay, IBC. Money multiplier. We got cash. It could be savings, checking, IBC, TMM. What else do we have? Where else is your money? Let's see. Yeah, so Christine, money with Rob Fuller, that's specifically where your money is. But when your money's not, I should have clarified, when your money's not invested, where's your money available to you? So other money you have that's not currently invested. So yeah, so 401ks, IRAs, perfect test. So this is going to be what we call qualified money. So qualified funds. So those are things, it's black one. So it's like IRA, 401k, SEP, simple, etc. Right? So those are what we call qualified funds. And then over here is going to be, let's call them lines of credit. So specifically HELOC. HELOC and different lines of credit, because there's people that have business lines of credit. There's people that have access to cheap lines of credit or even 0% credit cards, things like that, which you can leverage. So this is all stuff that we can leverage. Basically, you know, HELOC means we're just leveraging the equity in our home. So equity, lines of credit, things like that. So those are basically the 4 buckets of where we have money. Now, this one right here, qualified funds. So those are going to be your retirement accounts. So those are things like an IRA, 401ks, things like that. So depending on where this money is, if it's an active 401k, your options for investing that money are typically going to be like different funds that the 401k offers. They might offer like a bond fund, different volatility, different risk, you know, mutual funds or indexes, things like that. So a 401k, you might not have a whole lot of control over. You have an IRA or something like that, then what we're typically are going to want to do is roll that over into what's called a self-directed IRA. And that way, instead of just being limited to the stock market, you're now able to do private money lending. You're able to do real estate with it. You're able to buy rental properties, even things like that with the retirement funds. Okay. Now, there's different limitations on this, how much you can contribute to them. If you make a certain amount of money, you can't do like a Roth, for instance. But these are going to be your tax advantaged retirement accounts. So that's one bucket. Again, the best you can have in this is going to be a self-directed. So that way you can control the money and invest in almost anything that you want to. Okay. Even including precious metals, treasuries, you know, everything in that all seasons portfolio, really anything. Now, when you're thinking your qualified funds, typically what you want to think about is long-term. Okay. So let me give you an example here. I'm going to use a nice simple example here. So there's a cap fund right now. So the cap fund is a fund that our friend Andrew, you guys know Andrew from all the different things. Andrew does a lot of the tech and builds all Chris's PowerPoints and kind of like a technical engineer is what he does. But Andrew is also, you know, very involved with the business and understands all this stuff as well. So he partnered with Chris on one of the new funds. So it's called the Cap Fund. And, you know, it has returns right now of anywhere from 6 to 10%, depending on if you do, I believe it's 1 year to 3 years, depending on the term. So depending on the term, you can get a higher percent if your money's in there longer. So if we're looking at this from the terms of where our money is, well, if I wanted a nice safe investment, and the reason why I say I believe this is a safe investment is because of the fund managers that are investing the money from this fund. They're very strict on how they're lending it. So they're lending it on commercial deals, but it's only at I believe a 60% loan to value ratio. It's very conservative when it comes to lending money out. So they're lending very conservatively. And the managers behind it that do the investing have been doing it for like 30 years. They're very, very good at what they do. And again, I'm not a partner in this fund. So talk with Andrew or let me know. I'll connect you with Andrew. Just let him know that you learned about it on Money Club Mondays. So he knows what you're talking about. But So in this deal right here, you have an option where at 1 year, you can grow your money at 6%. If you go in for 3 years, you can grow your money at 10% a year. Okay. So if you're just looking for a nice, safe and short-term investment that you're not worried too much about getting crazy gains on, I mean, 6% is not bad for a nice, safe, short-term investment, then you can use the money from wherever, right? But if we're using the money from an IRA, for instance, and I'm 39 years old, I can't touch that money until I'm 59 and a half years old without taking a penalty. So I have 20 years that I cannot take this money out of a self-directed IRA. Okay. So what I would do is I would look at this and I would say, well, there's no advantage to get my money back in a year necessarily, because the money's going to be in there for the next 20 years, no matter what. So let me get the better returns and let me lock my money up for 3 years because it's in a self-directed IRA. I don't want to think about it for a while. So to me, the longer term, the better that I don't have to think about in an IRA. Because again, I can't pull that money out to use it for some big business project or some big opportunity anyways, where I really want to, own it myself, because in IRAs, you can't do self-dealing and things like that. So there's some limitations to them. So lending money from an IRA to something like a fund, a private fund, or a private lending deal, to me is a great way to use a self-directed IRA. Because of that long term. So I put my money in, I get the better returns, and I don't have to think about it for 3 years. So some other good investments, in my opinion, for an IRA, long-term stuff, notes. So like notes investing we do with Kevin Shortell, if you've been on our 3-day. So notes are just like buying mortgages, buying and selling mortgages. But a lot of notes can be long-term, right? So if I'm going to buy it, I'm going to forget about it, then why not buy a note that's going to pay me for the next 20 years? So notes can be good. How about precious metals? Gold, silver. How much do gold and silver pay in monthly interest? Nothing, right? So gold and silver we're buying with the thought that they're going to increase in value over time, that they'll become more and more valuable over time, but they're not paying us anything on a monthly basis. So let me ask this question. When I borrow money from a HELOC, and all of my markers are dead right now. Let me see if I have any more sitting around. So let me ask you guys this question. When I borrow money from a HELOC, do I need to repay that HELOC on a monthly basis? Right? Yeah, you do. So you're repaying interest only payments. So if I take $100,000 and I'm paying 5% on that over 12 months. So I'm paying $416 a month. So if I take $100,000 from this, I have to repay $416 a month back into it. Okay. So if I take $100,000 and buy precious metals, for instance, I'm not getting anything back. So I'm paying $416 a month back to my HELOC to buy something that's not helping me pay that HELOC back, right? So that's probably not a good place. So again, where the money's coming from is going to make a big difference on what type of investment in that all seasons portfolio we talked about before that we want to make. Does that make sense to you guys? Let me ask this though. On this deal right here, 3 years at 10%. So if I lent my $100,000 out at 10% that I had in my house, let's see this. So $100,000, 10% divided by 12. So if I was to take $100,000 and give it to Andrew for the cap fund at 10% for the next 3 years, I know that I have $833 a month coming back into me. Okay, so every month I'm going to get a check for $833. At the end of that 3 years, I'm going to get my $100,000 back. Okay, so if I take $100,000 from my HELOC, I put it into here, I have $833 a month coming back in, 416 of it goes back into the HELOC. I now have minus 16. I now have $417 a month for basically doing nothing extra, right? I just tapped into money that was sitting in my home just by me owning a home over the last few years. So it's a good way to get otherwise money that you would never even think about. I mean, sometimes a lot of people don't even realize that you can tap into the equity in your house that way, or go out to a home, a home loan agreement where there's no repayment back, and then the whole $833 a month is profit. So ask yourself, what kind of car do you want to, what kind of car do you want the equity in your house to pay for? Something cheaper or something a little bit nicer, right? So there's different strategies for tapping into that equity as well. But regardless of it, any of these lines of credit, any of these things, it all works off what we call spread. You hear us talk about this a lot, right? So spread. So the spread is very, very, very important, because if we're making 10 and we're paying 5, we're making a 5% spread, right? And that becomes more and more important as we start getting more and more advanced, running money from bucket to bucket to bucket. All right, so let me clear this up and we'll keep going here. Now, I'm going to get rid of the self-directed IRA, the qualified funds bucket completely, because that bucket right there, again, it's money we're putting into there and we're not touching until retirement. So we're not able to pull it out or move it from bucket to bucket to take advantage of other stuff. We're not able to really do anything else with it. The only thing you can do with this bucket, that's a little bit of a strategy, would be to do what's called a Roth. Called a Roth conversion. Sorry about that. So that's really the only strategy we can look at when we're moving funds. And all that would do, that would move the money from a traditional and it would convert it into a Roth. So what happens when that happens is, let's say you have an old 401k with $500,000 in it, right? Well, we're going to convert that $500,000 into a Roth. We're going to pay taxes on it at this time. Why would we do that? Well, maybe we would do that because we believe that taxes right now are the lowest that they'll ever be in our lifetime. Maybe we believe taxes are going to go up and up and up, right, for the rest of our life. So why not get rid of the tax burden now and then get tax-free growth for the rest of our lives? So that might be a good reason why. Did you guys realize the money in the 401ks, you do pay taxes on that later, right? You guys realize that? So let's take the hit now. Remember the 3 wealth killers: taxes, inflation, and volatility. So let's take that tax hit now, so then we get tax-free growth within a Roth for the rest of our life. Tax-free growth means we're eliminating completely one of the 3 tax killers, one of the 3 wealth killers, taxes. So by converting it, now we're getting completely rid of one of the 3 wealth killers in taxes. So that's the only kind of thing we can do with that. Because of Roth, you're limited to how much you can contribute into it. So if you're starting a Roth new, it's hard to get a bunch of money in there to make a bunch of money with that money. But if we can convert a decent sized traditional old 401k or old IRA or something like that into a Roth, now we're starting with a large amount of money that's tax-free that we can take and invest and really grow it a lot. I mean, this is the Mitt Romneys and people that you've heard over the years in politics that have done this, have millions and billions of dollars in their Roth accounts. This is how they did it. They did a conversion, and then they made some very smart investments into businesses and really grew their money tax-free very powerfully. All right, so we can get rid of that bucket right there. Now, let me talk about the cash bucket for a minute. So this is money that's just in the bucket. Remember, there's 3 other buckets now. We have IBC. We have HELOC. Okay. Now, let's talk about the cash for a minute. Do we want much money in a cash bucket? What do you guys think? In a true cash bucket, just cash that's sitting there in our account, not doing anything. What do you guys think? We want a little bit, right? So my suggestion would be 3 to 6 months expenses. So this, and maybe you want more, maybe you feel comfortable with less. myself, I'm right in the middle, just so you guys know. But to me, cash, that's true cash, that's just sitting in a savings checking, maybe in a safe, something like that, where you have access to it. My opinion, no more than 3 to 6 months of monthly expenses. Meaning if you lost all your investments, you lost all your income, you lost everything, you can live your same lifestyle right now over the next 3 to 6 months. Now, one of the things that we do to help with this, and why, even though I stay in the middle of this, I'm not real concerned with it, is through this right here. So that can really help with this, because if you have income coming in from a job, from a private money loan, from a side business, where else do you guys have money coming in from? Rents? Where else do you guys have money coming in from? So if we have money coming in from multiple locations, otherwise known as passive streams of income, or even not even passive, but just streams of income, right? So even if we have streams of income, well, let's say COVID hits and shuts everything down and eliminates your job. Well, guess what? You still have money coming in from your private money loans monthly. You still have money coming in from your side business on a regular basis. And you still have money coming in from rents from rental properties that you own on a regular basis. Resellers was one that paid people $750 a month for a while. Now that ends, but it goes into the streams of income, right? So that's why we want extra streams of income, to take a little bit of burden off of this emergency fund. You know, this is what we would call an emergency fund. Emergency fund. All right. So that's all that is. So if we have more than this in this bucket, then we need to look at what do we do with that money. Okay. So we could take it and we could put it into the portfolio, right? So we could put it into private money lending. We could put it into real estate. We could put it into precious metals. We could put it into treasuries. Right? We could put it into these places. Nothing wrong with that. What I would recommend, what I do, and what obviously what we're all about, is let's take advantage of as many rules as we can in this country, right? So there's two ways that we can take advantage of laws that are on the books in this country. One are through tax advantaged accounts. So for instance, that Roth conversion and now getting Roth tax-free growth for the rest of your life in the Roth, that's one. Another is whole life insurance. So that's what we use for IBC. The reason we use a whole life insurance policy that's specially designed and engineered with a mutually owned dividend paying insurance company is because there's no other vehicle in this country that has the advantages that that whole life policy has when it comes to how the money grows and what we can do with it. Because this IBC policy right here, if we take our cash that's growing at, what is the growth in a savings account right now? 0.1%. So instead of putting it into these places, and we could take that cash and put it into here, now we're growing our money. 5 to 6% is what the dividends are currently paying out right now. We're taking advantage of So not only is our money growing at a higher rate than in the checking or savings account, it never stops. So it's uninterrupted compounding interest. Even when we take our money out of here and we put it into a private money deal, we put it into our business, we put it into real estate, it still sits in there with uninterrupted compounding growth. And then something else. Also, the money inside of this policy is tax-free growth. So you're paying taxes on it today, money goes into the policy, it then sits in there and compounds and grows uninterrupted for the rest of your life, completely tax-free. So here we're starting to eliminate taxes, wealth killer. We're starting to eliminate volatility because this growth, uninterrupted compounding growth inside of here is guaranteed. Guaranteed. So there's zero risk It's guaranteed uninterrupted compounding growth. So we're getting rid of volatility. We got rid of taxes. We got rid of volatility. And then we got inflation to handle when it comes to the 3 top wealth killers for people. So how do we handle inflation? Well, our money's already growing better than it was over here. So we're starting to keep up with inflation. But what are we able to do with the money in here while it sits in there and grows tax-free? Like I just said, we can move it. So money in motion is always making more money. Money in movement is making more money. So we always want to keep that money moving, right? Keep that money moving, keep that circle going, keep those little green men out there fighting for you, making more and more money. So we want to take the money from the policy while it's doing all this, and we want to do different investments in that all seasons portfolio, which I'll talk about next with you. Okay. So maybe this sitting in here, anything more than that, no. We need to get rid of that. We need to start moving it into these different places. Why not move it into here first? And then let's move it into these different places. And before I clean this up, let me just talk about HELOCs. So like I said before, when it comes to HELOCs, we're working off of a spread. But there could be a better way to do that as well. So there's a couple trainings on the YouTube channel you guys can watch. But Joseph on our team was at the training in Daytona this weekend and did a little presentation. And I don't have time to go through the entire thing right now. But he is using HELOCs to fund his policies, to fund his business, to fund his real estate deals, that fund his private money loans, that then flow back up into his flow back up into his HELOC, that then flows back into the next year of IBC premium deposits. So he's literally using this HELOC as a way to create this entire money movement and money flow of everything. All right. And again, we have videos on that, so we can talk about that. But let me just take a picture of this ridiculous looking drawing that I just created there. All right, so let me clean this up and we'll keep moving along. So would you guys agree that the IBC, that this makes a lot of sense to start moving some money into? Remember, tax-free growth, uninterrupted guaranteed compounding growth, and ability to continuously move money to make more money. So we're eliminating the 3 wealth killers by putting our money here first. And again, whether we deposit our money at a bank or whether we deposit our money in our own bank, we're not working any harder, we're not working any longer, and we're not taking on any more risk. We're not doing anything different except where we're making those deposits. Would you rather deposit your money in your own bank and make yourself rich? Or would you rather deposit your money in Wells Fargo or Chase Bank and continue to make them rich? Choice is yours. If you guys have any questions or comments, put them in, please. Okay, so again, we're working off the spread, right? All right, so we pull this portfolio back up one more time here. Okay. Okay, so let's see what you guys are following. So precious metals, put in the comment box. What do you think would be a good bucket to fund precious metals from? What do you think would be smart to buy precious metals from? Remember the 4 buckets. This is where our money is. And by the way, while I'm asking this, does anybody have money anywhere else? I mean, did I miss anything? Is there people have money? Like, are you storing money anywhere else? Or are these the options? This is where your wealth is held, right? All right, so here we go. IBCs, people are saying IBC is a good place to fund precious metals. It can be. It can be. Remember, the good thing about precious metals is they tend to do very well. They tend to grow in economic conditions like we're in right now, when there's high inflation, when there's volatility, when people are scared of investments in the dollar. A lot of times they run to precious metals, which drives the price up. That's great. But remember, there's no spread as far as monthly income. So if we're using money from an IBC, we're paying, let's say, 4 to 5% to borrow that money. Now, we don't have to repay the money. That's up to us. So as long as our precious metals are growing at a rate greater than 5% annually, and we can afford to pay the interest from the cash that we borrowed from IBC to buy those annually. Remember, you're going to want to pay annually the interest out of your policy. You don't have to repay the principal, but you're going to want to pay the interest. So the IBC could be a good use. Maybe if you got some extra cash sitting around, more than the 3 to 6 months that you're comfortable with, maybe you're not ready to start a new IBC policy yet. That could be a good use. And this would be kind of the same for US Treasuries. Same thing with US Treasuries, right? They do pay a yield, but it's all kind of internal and stuff like that. So it's a little bit different than like a private money loan. So same thing. If you got a little bit more cash sitting around, then you can get into an IBC policy. Maybe you're not ready for your second, third, fourth policy, your next policy yet. The money's just sitting around in the center. So that could be a good place if you're to use cash. Also over here into Treasuries. IBC, like I said, it can make sense. I don't know if I would use a HELOC. I think you're going to have too much repayment to really want to deal with that. IRA, I think an IRA would be a great place to do it. Any questions on precious metals? And remember, an IRA can buy precious metals. It just has to be the right kind. So the most popular are like silver eagles. But remember, you can't just buy like bullion. Bullion, collectibles. Those are no-nos. Those are no-nos when it comes to an IRA. You can, however, buy like silver eagles, gold eagles, things like that, Canadian eagles, I believe. There's different ones that we can buy with the IRA. So just make sure we're doing that the right way. I can help you guys with that, especially if you're in 7K. We have a real easy flow on how it goes from Horizon Trust into 7K to the depository it needs to be sent to and everything like that. So there's certain laws for buying precious metals with an IRA, but I think it's a great thing because, again, it's long-term. And what are we thinking about with precious metals? The long-term growth. So they can be used in all these. I got no problem with any of that. How about, let's see what else we got in here. Like I said, so precious metals and long-term treasuries. How about real estate? How about actual rentals, real estate? Remember, the real estate, there's so many different types of real estate. There's commercial, there's multifamily, single family, mobile home parks, there's land, there's flips, there's short and long-term rentals. So there's all kinds of different types of real estate, but specifically, there we go. So specifically, rentals, short and long-term rentals, and which, by the way, next week I have on a company that we've been working with for a while now that does what are called turnkey rentals. So they will find a buyer. They help you secure the loan and leverage your cash. So cash could be a good thing for buying real estate. Property management company. In the house. So the company I have coming on next week is going to talk about buying turnkey rentals. So that means you're actually purchasing the real estate and you own it. You're now the landlord. You actually own the real estate. You're not just doing private money lending passively. You're actually going to be an active owner. However, with these turnkey rental companies, they're very good at what they do, and they take all the active parts of real estate investing and do it for you. So it's still a passive way of investing, but still taking advantage of all the, still taking advantage of everything that comes with actually owning the real estate. And there's a lot of advantages. I'll go through that. So that's what we're going to do next Monday. They're coming on. Vindy and I believe Ivan are going to be on too. Ivan will be on too. And we're going to talk about turnkey rentals. So why would we do that? All right. And with these turnkey rentals, they find the house, they find the buyer, they help you secure the loan to leverage your cash, and they have a property manager in place. And all you do is collect the money, really. So it's pretty cool how they work. Now, rentals, whether it's short-term or long-term, Airbnb or long-term traditional, annual leases, which buckets would be good to buy real estate with? So really, in my opinion, any of them. But there's pros and cons. So when it comes to an IRA, remember, with an IRA, if you were to purchase a house to use as a rental, there's a lot of restrictions and rules that you have to follow. So if you buy it with 100% of the money, then 100% of all work, of all maintenance, of all cost, expenses, of all profit comes from and goes to the IRA. If a portion of the IRA is used, then it has to be proportionate to how much you used in IRA funds and how much you used in cash funds to how all of that works. So it can become very complicated. One of the cool things about short-term rentals is if I have a condo in San Diego on the beach that I'm renting out, but I want to go there and spend a couple weeks a year at that short-term Airbnb rental that I own, I want to be able to do that. That's one of the cool things about Airbnbs is you can go use them yourself. But if I was to buy that property with an IRA, I'm not allowed to personally use that property at all. People in my family cannot personally use that property at all. So there's a lot of, so things like that. Also, what is your money in an IRA doing as far as taxes go? It's already growing tax-free or tax-deferred. What do rental properties and real estate in general provide to you? A lot of tax benefits. Okay. So if I can use real estate, to drastically lower my tax bill that I'm paying with cash, then I want to take full advantage of that. With an IRA, you're kind of losing those tax benefits because it's already in a tax advantage vehicle. So there's some drawbacks to using an IRA for real estate. You're giving some things up, you're giving up some uses possibly. So it just depends on what you're doing with it, but just keep that stuff in mind when you're looking at using this bucket to fund things like rental properties. How about a HELOC? Love it. What are we taking advantage of there? Something called leverage. So leverage is one of my favorite parts about real estate, right? All leverage is if this home right here, let's say this house is worth $100,000. Well, I can go to the bank with $20,000 cash or from an IBC policy or from a HELOC, and I can purchase this property with $20,000 that's worth $100,000. All I have to do is obtain a loan. Whether it's a private money loan, whether it's a bank loan, whatever it is, I'm leveraging what I already have to purchase more. So if I'm leveraging a HELOC, this is equity from a home that I've already leveraged once before. It's more equity that I'm now leveraging to get another loan to buy more real estate. So again, you have to be disciplined. You have to be smart to make good investments because a lot of this kind of stuff was going on back in 06 and 07, it led to a lot of what happened with the 08 collapse, people getting loans and leveraging properties that they should have never been able to get or obtain or leveraging in ways that they should have never been able to do it. There was a lot of zero, no money down. No money down, which basically equals 100% leverage. I mean, you should never really be 100% leveraging out, right? So a lot of little things like that were happening, but just stuff to, stuff to think about. An IBC policy, again, where we're taking advantage of leveraging and we're using our cash, whether the cash is sitting here, whether the cash is sitting here, both great ways. Because remember, the money inside IBC is tax-free growth. But once the money comes out into an investment and we move that money, now it's out of that tax-free arena. So now all the profit we make from the money on this deal, from the money on these real estate deals, whatever they might be, that money's now taxable before it goes back into the policy. So by buying real estate with our IBC money, it's a great way because now we're taking advantage of all the different tax deductions that real estate provides to us. So those are some of the pros and cons of actually buying actual real estate with these different buckets of money. And it could be similar with private money lending too. But I do want to say one thing on private money lending before we move on here. All right, so one more time with private money lending. Buckets, we got cash. So those of you that are doing private money lending already on here, where are you lending from? Tell me real fast in the comments. Which one of these buckets? Cash, IBC, HELOC, or IRA? Where are you lending from right now? Where's the money coming from? Bob, if you're still on, just email me and I'll check on your policy for you. I'm going to get to all that this afternoon. All right, let me see. IBC, self-directed IRA, HELOC, IBC, cash, IBC, home equity agreement. Very good, David. George from his new IBC, self-directed IRA, self-directed IRA. Okay, awesome. So it looks like a pretty big mix of everything. All right, so private money lending, cash, very straightforward. Put our money into a deal. Let's say it's 12%. We make the 12%, let's say $100,000. 12%, $100,000 equals 1,000 a month. Okay. So on a cash deal, we put $100,000 into this private money deal at 12%. It pays us $1,000 a month coming back, and then a return of principal at the end. So we make 12% on that deal. We're going to pay some taxes on that money, but it creates $1,000 of passive income. So I guess a negative would be taxed. Positive is passive income. A negative is it's taxed. What about IBC? Same thing. When the money comes out, it's taxed. Positive is the passive income. But what do we get with the money coming from IBC instead of a true cash like a traditional bank? What advantage do we get when it comes to lending from here? Well, we get uninterrupted compounding growth simultaneously. Well, one of the downsides we get from this is we have the loan, right? So we pull money from the IBC, it's a loan at, let's say 4 to 5%. So if we're making 12 and we're paying 5, what are we doing? We created that spread. So we're still making we're still at $1,000 a month coming into us. But at the end of that year, we know that we're going to have to pay that interest back to the IBC, to the insurance company. So we're creating a spread. Now, if each month the money comes back in, the $1,000 a month, if you're taking that and putting that back into the policy and you're waiting till the very end to take advantage of any profits that are left over, then you're not going to pay a true 4 or 5%, because just like that example where can you make more paying 6% while earning 4%? Absolutely, because one of them is a depreciating payment that we're making. The other one's in a compounding interest that it's growing at. Same thing with this. If the money's going back in each month, we're not going to pay that whole amount. So let's say we pay an active or an actual interest of 3% at the end of the year. So we still made 9% on our money. But again, our money's now in the policy compounding and growing. So the first year of this policy, you might have made 9%. But if I look at this policy in year 8, Let's say you've had this policy for a few years and we lent the money from the IBC policy that was already in its 8th year. Well, in the 8th year of that policy, our money had cash on cash returns that year of, let's say, 48%. So by taking the money from the policy, we had 48% internal tax-free growth, and we still made 9% spread that year on our money. So we just created a 57% return on our money that year instead of just a 12% return on our money that year. So again, it works off of the spread, and it works off of what year your policy is, how efficient is your policy. That's going to determine your actual returns by doing private money lending from your policy. So this is not as set as it's 12%, $1,000 a month, and that's it. There's a little bit more to it, but I think that the advantages to having a little bit more to it are worth it. What do you guys think? Like HELOC, same thing. We're just working off the spread. There's no uninterrupted compounding growth or anything like that. So we're simply working off the spread. But that, again, that's money that otherwise would just be sitting in your rafters in the walls of your house doing nothing for you. So in my eyes, this is free money. So if I create a 7% spread because I'm paying 5% of the HELOC and I'm making 12%, I create a 7% spread. That's, to me, that's 7% of free money. And $100,000 is 7% is $7,000 a year, which is $583 a month, which is a car payment, right? I think my wife's lease that just is about up right now on the little Acura SUV she has, which, by the way, I leased that before I learned about infinite banking. Her next car, when this lease is up later this year, will be bought from her new banking policy. But nonetheless, we have a lease. I think it's like $590 a month. So that HELOC right there could make that car payment. So no problem right there. Pretty straightforward. An IRA, same thing. This is just taking advantage of tax, either deferred or free growth. And again, if I'm gonna do private money lending out of my IRA, I'm probably gonna want long-term. Long-term makes sense because, again, we can't touch that money anyway. So why not put it somewhere where we can forget about it? So, Dwight Harrison, Steve Lawson, I know there's a couple other investors, but they have some really cool deals right now. 5 years, 7 years, some of them even longer. Notes investing, same thing. Notes, I mean, you could buy a 20-year note. You buy that thing, stick it in your IRA, let it grow tax-free, and boom, you don't have to worry about it for a while. So those of you doing private money lending from your IRAs, I love it too. That's a great use of the money, as well as the other stuff. And the home equity agreement that David was saying he used is basically this HELOC, but without the spread. So he's making that full 12% for free. That free money is the full deal because he has no repayment through a home equity agreement as opposed to a HELOC. So that's really cool right there. All right. So I know we're coming up on the time right now. So was that helpful today? Did that kind of open your eyes a little bit to, the whole idea was just start thinking again, where's your money? Am I keeping my money moving at all times? And am I taking advantage of all these different rules that are on the books that allow us to move money in these different ways into these different types of deals so we can accomplish that all seasons portfolio at the end of the day? Be smart with our money, protect our money, and always have our money growing for us, always have our money moving and making more money for us. And again, if we take the people, remember, taxes, inflation, volatility. Those are the 3 wealth killers. In the last 10 to 12 years, we might have gotten a little lazy. We might have forgotten about this. We've been living in a pretty easy world. The volatility has not been there. It's been up, except for a couple little minor things. For the most part, it's been up. Inflation's been under control until COVID, until everything that's happened recently with the printing of money and everything. That has not been an issue. Taxes are always an issue, but at least you know what you got. There's always something we can control, but there's so many proposals out there right now wanting to increase taxes, wanting to tax unrealized gains, wanting to change some of these different things. So this is something that we're always moving and always looking at, but we want to look at those buckets again. Where's our money? And how do we use each one of these buckets to our advantage the most possible and move it into the right places to avoid volatility, to get rid of inflation, and get rid of taxes. Even with real estate, again, depending on what bucket you're moving from, when you buy real estate, you can get tax advantages or not. So we always want to be smart about where our money's moving. So if you guys have any questions about this stuff, if you want to talk about your situation, you want to walk through it, just schedule a call with me, shoot me an email. Let's talk about it. Let's make sure you if it's time for another policy, let's get that policy started. If we can do a Roth conversion, take an old 401k, something like that, let's get that process started. But let's prepare ourselves, because there are a lot of moving parts going on in the global economic world, right? There's a lot happening. A lot of it, 99% of it, is out of our control. At the end of the day, we can vote, but that's about it. At the end of the day, this stuff's going to happen, whether we cry and complain and bitch and scream, and it doesn't matter. It's going to happen. So we need to worry about us. That's why we always say nobody cares more about your money than you do. Take control of that money, take advantage of these rules and laws that are on the books, and let's get your money moving and get it into the right places. So you're not only protected when things start to really collapse, but you're prepared to buy in when everything goes on sale and create millions and billions of dollars for you and your family into the future. So with that being said, let me just look through these questions. I don't see any Q&A. There's one in here. Yeah, Bob, I just saw your email come through. I'll definitely check on that for you. Yes, this is great, and prompted me to send you an email. Sounds good, Catherine. If you guys email me, just give me a day or two. Again, I was gone for since last Thursday, and just need to catch up on some stuff this week. But let's definitely talk about it over the next week or so and get you going. And if you send me an email, I promise you I will read it and respond. What is the TX to move the traditional Roth? Yeah, Christine, just let me know. Just email me and we can connect on that. So thanks for being here, guys. Like I said, next week we'll have on philanthro investors talking about turnkey rentals. And each week moving forward, I will have borrowers lined up and investors lined up to start presenting their deals. I'm going to hammer them just like a shark would, and look at it like I'm investing my money. So that way you guys get all the information you need to make that decision. Hey, is this an investor? And is this a deal that I want to work with and that I would consider lending my money to? If it is, then we can connect you with that person. If it's not, then you move on to the next week and the next deal. But this is all through the Private Money Club, privatemoneyclub.com. If you're not already a member, it's $9.97 a year for borrowers and lenders. Once you're in there, you can do whatever you want. You can lend all the money. You can borrow all the money you want. We don't take a split of any of it. The percentages that are paid, the points that are paid, the terms that are made are between you, the lender, and borrower. We're not involved. We don't take a piece. It's just the $9.97 a year, and that will go up later this year when we launch the new version of Private Money Club, which the developers are building for us right now. So that's it.
So I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.